Good day, fellow investors. This was a great comment by DSM discussing how one should be careful when it comes to estimating extreme scenarios. I discussed how inflation might be even 6% per year over the next 25 years, which is much higher than 2.5% over the last 25 years. But let's discuss the investing implications of these two different perspectives on what can happen. Because I want to discuss money fragility, the piled debt, how it might lead to inflation, what are the system failure risks, and then how that all trickles down to wealth management, wealth compounding, wealth accumulation, or even just preserving. Let's start immediately with the fragility of money. What is the only solution applied in the last 25 years by governments to any kind of issues? If we look at the Federal Reserve balance sheet, similarly in Europe, everything was stable, great financial crisis, let's print some money, let's lower interest rates, and then let's do it again. Pandemic, let's print more money, and the balance sheet over 20 years is a simple 10x. More liquidity, more money, and that is how things have evolved. What will happen when the next issue comes? Well, I would not be surprised that they will simply print more money. And that is not just issues, because they will need to print money just because of the fundamentals out there. If we look at the economy, if we look at deficits, if we look at government debt levels, look at this. Debt to GDP in 2008-9 was 30-something%. We are now going to 120 on very positive assumptions. No shocks assumed there. Interest rates are expected to go lower because the situation is bad, therefore lower interest rates. However, when it comes to interest rates, just a while ago we have had peak inversion 2023, and now we already have a steepening of the interest of the yield curve for the US government, where the government already needs to pay close to 5% for long-term borrowing, and this is then just based on the short term, on the assumptions of the Fed. But with this situation where half of the deficit is just to pay net interest, which is then compounding on higher and higher, you need to borrow to pay more interest, and if interest rates get out of control, then you are in trouble. So it is like the 1970s, but then for 25 years long. The difference between the 1970s, look at the debt levels, there were none. Now debt levels are skyrocketing. And therefore I'm saying that the system is much more fragile than in the 1970s. However, the comment is correct. I do not expect linear inflation growth. I do not expect inflation to suddenly be 6% per year and that's it. I would rather not assume, not predict, but the key is to be ready for. We have, let's say, inflation at 2-3% for the next decade, and then in 2036 we get 100% inflation in 1 year to bring to that average of 6%. Given the fragility of the economic system, you will not get linear growth. The markets are not linear, the markets are not rational. You will get shocks. And that is what I am being ready for in the next 25 years when it comes to investing. That is what I'm discussing here. Because if you look at inflation, we have had a mild shock with peaking at 9% in 2022. Now it is above the 2% expected. Okay, this is government measuring, so real inflation is 3-4%, something like that. However, there are other factors impacting inflation like demographics, less people, less demand. However, on the other side of the world, you have global demand growing, more people, more development, technology, AI. AI might lower prices for a while until those balances let's say, even out. But then you have unemployment. You're going to print money to give to those people or take more debt. So those are all factors that can't be assumed linearly. We have to also take into account the growing demand for commodities over the next 10-20 years, depending on commodities, and then of course measuring inflation, how inflation is measured, because inflation depends on where you are. If you are, for example, in the Netherlands, house prices have doubled over the last 10 years, even more depending on the areas. In Italy, house prices are up 10%, just 10%. But when it comes to measuring inflation, then you have the average, which is somewhere in between, depending. So there is always statistics, and then there is always impactful reality. With managing inflation, what the Fed's target is, 2% inflation, it works until it doesn't. And history has always shown that at some point, if the system is fragile, like it is unsustainable to keep spending more than what you are making, than what the economic growth is, than what the growth in productivity is, which is going on now, and it's unlikely to revert. That means that the system will, due to its fragility, break somewhere in the future. When? Nobody knows. 10, 20, 30 years, nobody knows. The key is, when investing, that these shocks don't wipe you out. Because if these shocks wipe you out, then you might be compounding for 20 years, and year 21, you are wiped out, as many were in 2009. It's not impossible, I agree. It's an extreme assumption, and that's what we do here. We discuss extreme assumptions because we want to be ready. If something happens and there is 1% chance, but it happens, I have to be ready from a value investing perspective to that. Because that is investing for me. Am I better off? Am I well off? Am I getting richer? Am I accumulating more wealth? No matter what happens. That's why I discuss these scenarios. I'm not predicting. We could have deflation for the next 20 years due to technology, who knows what. However, I need to be ready for both. I need to have a margin of safety so that whatever happens, I am protected. Because as said, when systemic risks happen, simply markets that you might consider successful, working, doing well, liquid, simply get frozen. This is the credit non-agency mortgage security market 2008. It simply disappears. And you see also other indications. The Dutch pension system is switching from a defined benefit to a defined contribution plan. Simply, the system is saying this is not sustainable, we cannot guarantee your payments, it will depend on the future, interest rates are low, equities are expensive, take high risk, and enjoy if there is something left of your retirement. These are very tricky shifts into how things are managed, how things are working, that will have repercussions, again, over the next few decades. I hope later rather than sooner. They are saying that there are various reasons, but the only reason is this is not sustainable. We need to bet on depending on what the markets do. At these levels, markets will likely do badly on a real term perspective. Therefore, we have to give you real pensions, which are bad. But then that is weaker than what people expect. This can lead into populism. This can lead into, again, money printing that we discussed at the beginning of this video. As I said again, we don't know what will happen. Nobody can promise you anything, as the pension system is now saying, but we as investors here have to be ready for anything. When it comes to investing, I would not want to bet my wealth, my long-term financial well-being, on the low possibility that something might happen or not. Tail events happen all the time, even more frequent than you might imagine, and therefore I need to invest in a way so that I am well no matter what happens. Thanks for watching. For more information on how I invest my portfolios, check my research platform, also in the link in the description below.